your highlighting of the Dodd-Frank 10% issue, and in a recent speech you talked about the size of banks and whether or not universal banks delivered a economic benefit above a certain size. What would you like if we just put to you the very broad question, should we limit the size of banks and how should we do it? How would you respond?
So I've had a nerdy fascination with this question of whether bigger is better in banking, whether it makes for extra efficiencies. So we've done quite a bit of thinking and research on that, and I think when you do the analysis properly, or as well as we can, as you say, it's very difficult to discern significant benefits for banks that have balance sheets much beyond, let's call it $100 billion, which is less than a tenth the size of some of our bigger banks currently. Now, there are different ways of cutting the cake. Lord Lawson mentioned one, which is the structural separation route would be a way of lowering the size threshold. But I am struck about some of the direction of travel of the debate in the United States, where we have some regional bank, Federal Reserve regional bank presidents arguing for size caps. We have some US senators arguing for size caps. We have the vice chairman of the FDIC, the Deposit Insurance Agency, arguing for size caps. And just as recently as 2 weeks ago, we had a vice chairman of the Federal Reserve Board, who leads on financial stability, floating the notion of a size cap. I don't personally have a strong position on this, but it strikes me it is an issue we should work through and reach a view on. The Dodd-Frank rule you mention is it's a market share rule over the deposit book. That, I think, takes you some way. It doesn't fully solve the too big to fail issue, because it doesn't prevent that deposit book still being enormous, or the banking system still being enormous relative to the economy as a whole. So if you're really worried about the big banks imperiling the solvency of the state, you'd cast your size rule not in terms of a market share of the deposit book, but as a share of the economy, as a share of GDP, which is the direction that the US debate has taken.
Just going back to the early exchanges, there seems to be, you put up a good case for the need for a comprehensive cost-benefit analysis of doing some serious platform work, not least to help restore trust in banking. But we need something that's going to be done in a way that will be credible and not ignored by people with the moral authority to, if necessary, induce banks to be more cooperative in thinking this through. After all, we will need their cooperation to do this work.
Absolutely.
Don't you think the PRA is probably the best place to do this? Or to commission it? Who else are they going to take notice of if not the PRA?
I think it could be the PRA. I think it is important, Mr. Chairman, to distinguish between the body that's lead managing the project, where it may make some sense for that to be a prudential agency, or indeed a competition agency. It could be the
touches on that have regards point.
It touches on that. There may be, I think there would certainly be some benefit, however, in the inputs to that review coming from a broader range of individuals. I would want to bring competition economists into the picture. I would want to bring technology companies into the picture to get as accurate a picture as possible of how much this would really cost.
Yeah, no, we're clear that the Bank of England doesn't have the in-house expertise to do it. But who's going to lead the project is what I'm asking. And you're saying, yes, PRA might be a suitable place.
It's certainly one option.
Nigel Lawson has a quick question, and then John.
Very quick question. The bankers will say, the British bankers will say, if you're going to impose, say, size limits on British banks, or a number of other things which may be very desirable in themselves, you will be disadvantaging British banks compared with their competitors overseas, and that is unacceptable. Now, I believe there's a good answer to that, but what I'm interested in is, what is your answer?
And just to be clear, I wasn't today formally proposing size limits. I think it's an option.
Well, let us look at the various options which you might think are desirable. And that's a possibility. That's an option. Yes. Full structural separation, the complete glass deal is another, and there are various others which, on their merits, may seem persuasive. But the British banks will say, you are putting us at a disadvantage compared with our overseas competitors, and that is unacceptable. My question is, what is your answer to that?
This is a very interesting piece of research that came out earlier this year, which looked at the question, what is the relationship between the size of the banking system and growth within the economy? And that piece of research was very significant because it overturned a piece of orthodoxy that had existed for 20, 30 years, which is that bigger is better. The bigger the size of your banking system, the greater the extent of financial depth, the higher is growth. And what this study showed is that is only true within limits. So, roughly speaking, based upon their numbers, as soon as private credit to the private sector, exceeds something like 100% of GDP, those benefits begin to fade away, indeed go into reverse. And one of the reasons for that is that you find both people, human resources, and financial resources, capital, being sucked into finance and away from the non-financial parts of the economy in a way that retards, slows down productivity growth in those non-financial parts of the economy. If you believe that research, if you take the results at face value, what it would suggest is that far from there being some cost in limiting size, there may actually be some broader benefit to the non-financial economy from having those limits in place. Now, I don't know quite where that threshold exists. I'm not saying the research I mention couldn't be questioned. But I think the proposition back to the financial sector would be that actually a size limit, some limiting of bank balance sheet size could actually be net beneficial to the broader economy, to resources flowing into the non-financial sector. In particular, those sectors that are reliant on skilled labour. The research and development intensive industries, this study suggests, are particularly badly affected by physicists and mathematicians, scientists flowing into finance, of which there's been a real flood over the last 20 or 30 years. So I think my, again, rather researchy, I apologise for being rather researchy, answer to your question is that while this might not be the best answer for the financial sector, narrowly speaking, it may be a better answer for the broader economy.
But my question, it's very interesting to research, but my question was not about the size of the financial sector. It was about the size of the individual institutions which make up the sector.
Yes.
So what's your answer?
You seem to be conflating two things.
Yeah.
What's the answer to the point about bank size, not bank sector size?
Well, I think if you, in some ways, they do join in the middle. Because let's just say, and again, just to be clear, I'm not proposing this. You were to impose some size limit relative to GDP on an individual bank. That by itself would place some limits on how big banking is in its entirety would be relative to the economy as a whole. As I say, the evidence is that once you get to banks that are in excess of, as I say, $100 billion in assets on the basis of the existing evidence, it's hard to discern them delivering additional efficiency benefits to the customer. So that will be the proposition back, that the efficiency benefits are exhausted